We're now on the last chapter before our first test, so we'll be done with Module 1 shortly. I have the test dates on the module overview sheet. You should have already planned your test date and test time during that date. You can either do it on campus at the testing center in outreach, or you can do it through Proctor U, where they actually go ahead and watch you take the test from your home computer or computer at your location if you're doing an internship or something like that. Statement of cash flows actually became a mandated statement in the late 70s. What happened is companies had a strong balance sheet and they were going out of business, or they had a strong income statement and they were actually still failing. And the reason why is because they didn't have cash flow to cover their daily operations. So the statement of cash flows was developed and required as a mandatory financial statement. So we have three main areas on the statement of cash flows. We have operating activities, investing activities, and financing activities. The most important one, of course, is operating activities. We want to see the majority of our cash flows come from operating activities. That has to do with our current assets and current liabilities. Investing activities has to do with our long-term assets, and then financing activities have to do with liabilities and owner's equity accounts. We do know what our cash flow is from year to year. If you were to look at a balance sheet from 2012 and then look at a balance sheet from 2013, let's assume in 2012 we had $10,000 in cash. In 2013 we had $20,000 in cash on our balance sheets. We know that our cash has increased by $10,000, but we don't know where that came from. If it's not coming from operating on a consistent basis, we're in trouble. If we're having to borrow money through investing activities or sell assets as an example, or I should say borrow money through financing activities or sell assets through investing activities to generate cash flow, we're in trouble. It's kind of like selling your truck for gas money. So we want to see our cash flow healthy in operating activities. So what happens to accounts when we have that increase from year over year? I gave the example of cash. Let's look at assets. So if we were to look at accounts receivable is actually when you loan people money. So if you were to loan somebody money, if your accounts receivable went up, that would decrease your cash flow. When you loan money out, you have less cash available. By the same token, inventory. If you were to go ahead and go to the grocery store and pack your freezer with supplies, you may have an increase in inventory, but you have to spend cash to do that. So with assets, we have an indirect relationship. As assets increase from year to year, cash flow decreases. On liabilities and owner's equity, is just the opposite. If we were to go ahead and pay off a credit card, so our accounts payable decreases, our cash flow is going to decrease. By the same token, if we were to go ahead, instead of using cash to pay rent and we could put it on a credit card, we would increase our accounts payable and we would increase our cash, because we would have that cash for rent in the bank, possibly for spring break. I don't know how you all plan your vacations. And owner's equity is the same thing. If we go ahead and we sell stocks, or our stock account increases, our cash is going to increase because we're going to go ahead and sell that stock for cash. So assets have an indirect relationship, and liabilities and owner's equity have a direct relationship. And when I'm talking about this, when we use the statement of cash flows, we're actually going to use two balance sheets and an income statement. So as an example that I used before, we'll use a 2012-2013 balance sheet, and we're looking at the difference of year over year on those specific accounts. And then from the income statement, we're actually going to go ahead and start with net income and back out other expenses, and we'll go over that shortly. So with operating activities, what we do is we start out with net income, and then we add back depreciation and amortization, because those are actually artificial ways that we decrease our net income so we pay less taxes. So they don't affect cash flow, so we're going to go ahead and back those out. Then we reverse gains and losses, because gains and losses are going to be looked at in investing and financing, and they're not going to be looked at in operating activities. So we're going to reverse our gains and losses, and what that means is if you have a gain on the income statement, you're going to subtract it out on the statement of cash flows. If you have a loss, you're going to add it back in. And then we examine the changes in our current assets and current liabilities. Now, we don't look at cash or cash equivalents. When we do the operating activities, we look at the other accounts. And we're going to look at the change from year over to year. Of course, if we have an increase in assets, so if our accounts receivable goes from $10,000 in 2012 to $30,000 in 2013, we're going to have a decrease in cash flows by $20,000. As I said before, in investing activities, we're going to look at a change in non-current assets. And as I said before, an increase in assets causes a decrease in cash, and the reverse is true. A decrease in assets causes an increase in cash. So we're going to have an indirect relationship with our assets change. Financing activities, we're looking at non-current liabilities known as equities, I said before, and they have a direct relationship. So as notes payable increase, our cash flow increases, and the reverse is true. All right, so we have a four-step approach to preparing the statement of cash flows. As I mentioned before, the only portion of maybe I didn't mention it before, but the only portion of the statement of cash flows that I'm going to require you all to know how to calculate is operating activities. So this information right here is just for multiple choice questions and for your knowledge. First thing is we're going to determine the cash flow from operating activities. Then we're going to do it for investing, and finally for financing. And then the cash flows by activity is on the statement of cash flows. So the statement of cash flows is going to, actually the last line is a change in cash, which should mirror our change in cash from the two balance sheets that we discussed earlier. So it's actually a pretty straightforward process. Okay, so now you have homework to do for the statement of cash flows and a test, and we'll start in Module 2 shortly.